And welcome to this week's Video Insight. Well, it's an interesting time in global equity markets. We started this year with record low interest rates in many parts of the world, generally sluggish economic growth in Australia and elsewhere, but also generally buoyant equity markets. More recently, we've seen a high level of volatility and uncertainty, with a breakdown in negotiations between Greece and its creditors and a severe sell-off in the Chinese equity market, adding to investor concerns. With all of this going on, a lot of investors will be thinking about how they might position themselves for the months ahead. Unfortunately, there are a few easy answers here. Correctly forecasting the short-term direction of equity markets is incredibly hard to do, and I'm not aware of anyone who is able to do it reliably. At Montgomery, it just doesn't form part of our investment process. However, what you can do with some success is frame long-term investment decisions around value. If a sell-off in equities makes them cheap, then you can expect to do reasonably well long-term buying them at that level, even if they might get cheaper still in the short term. Conversely, buying equities when they're expensive usually doesn't lead to good long-term performance. So where do we sit currently in terms of value in the Australian market? Well, since April, the Australian market has fallen nearly 9%, and that's brought it closer to fair value, but on our numbers, the market is neither particularly cheap nor particularly expensive. In these circumstances, we don't think it makes sense to sell high-quality businesses with good long-term prospects, but nor do we think it makes sense to deploy a lot of extra cash into the market. In the months ahead, we may see a clearer picture, one way or the other, but for the time being, we think the market offers a reasonable balance between upside and downside. That's all for this week. We'll be back with more next week, and in the meantime, you can follow us on Facebook and Twitter.